He represents a district, Dayton, Ohio, that has been particularly hard hit by the foreclosure crisis. And I want to recognize Mr. Turner to talk about what he's seen happen in Dayton.
Well, I want to thank Brad Miller for his leadership on this issue. This is a very important issue that affects our whole country. And, we all took a pause as we saw our financial institutions shaken nationally. And as the bailouts were proposed that came here to this floor to be voted upon, across the country, Americans wondered, how did we get here? How did this happen? Now, I voted against every bailout that came here to this floor. And I voted against it because not only did I believe that they were not structured appropriately, that there was money that was going to be wasted, but more importantly, not one of them included a change in the laws that would prohibit the type of practices that got us here to begin with. The toxic assets that people talk about are these mortgage-backed securities that were traded and sold upstream. They were these securities that were based upon practices of mortgage lending that had a negative impact on our families and a negative impact on our communities. And today I wanted to offer my support for the recently passed bill, H.R. 1728, Mr. Miller's bill, the Mortgage Reform and Anti-Predatory Lending Act of 2009. This bill directly addresses the root causes of the current financial and economic crisis in the United States, as well as how it has led to some home abandonment and high foreclosure rates throughout the country. Mr. Speaker, the United States is experiencing a steady increase in foreclosures and mortgage lending problems that have impacted homeowners, families, communities, the United States economy, and global economies. In 2006, there were an estimated 1.3 million foreclosures in the United States. This number has increased by 79% in 2007, bringing the estimated number of foreclosures nationwide to 2.2 million. In 2008, an estimated 3.2 million foreclosures were reported nationwide. Estimates suggest that this trend is likely to continue, with millions more of Americans potentially losing their homes to foreclosure in the next 4 years, and with foreclosures not abating until perhaps 2011. Recently, an analysis by the Associated Press reported that Ohio has 3 of the most vacant neighborhoods in the United States, where home foreclosure and abandonment has devastated neighborhoods, with parts of northwest Dayton, Ohio, in my district, with more than 40% of the area being vacant. This statistic makes northwest Dayton the 9th emptiest neighborhood in the nation. If you look at the 2008 foreclosure rates in my district, there have been 4,091 foreclosures in Montgomery County, the primary county of my district. There were 1,558 foreclosures in Warren County, 287 foreclosures in Clinton County, and 351 in Highland County. These statistics become even more real when I open the pages of my local newspaper. When I was home over the past couple of weeks and I looked at the newspaper, I actually compared the number of pages that actually contained news to the number of foreclosures. The Dayton Daily News the other day showed up on my doorstep. It had 14 pages of news nationally and worldwide, and 14 pages of foreclosures. Those are foreclosures that affect families, communities, and neighborhoods. The families that live there, the children that live there, and the neighbors that live next to the homes, and the neighborhoods that begin to decline upon foreclosure and abandonment. According to a study commissioned by Jim McCarthy, the head of the Miami Valley Fair Housing Center in my district, the mortgage foreclosures associated with lenders who are identified as subprime lenders increased at an annual rate of 43% from 1994 to 2000. This number is more than double the annual 18% rate increase associated with lenders who are not identified as subprime lenders. The study also showed that foreclosure filings in Montgomery County, Ohio, nearly doubled from 1994 to 2000, and that subprime lenders were responsible for a disproportionately high share of that increase. In Montgomery County, the number of predatory lending complaints since 2001 have risen to 5,326. Home foreclosures resulting from predatory lending take a toll on American cities. Properties which are foreclosed often sit vacant for long periods of time and not only become an eyesore, but become a threat to public health and to safety. Boarded up neighborhoods, falling property values, increased crime, all lead to an eroded local tax base and impair a city's ability to provide important services to urban families. Additionally, when I served as mayor for the city of Dayton and faced this issue and how it impacts homeowners, my community continued to wonder how the financial markets would be able to sustain the losses associated with mortgage foreclosures. Because the individual impact resulted from predatory lending, these practices were resulting in the loss of capital in the market that cumulatively one would expect that it would have an impact. Now, I want to show you some of the boards that I have beside me. These are the home foreclosure numbers for Montgomery County from the years starting in 1997 to 2008. Since I've been in Congress here for 6.5 years, in a county that has a population of slightly more than 500,000, there have been about 27,000 foreclosures in the community. The number of families that are impacted, the number of houses in the neighborhood is just really astounding. I want to show you a representative map of a neighborhood that would show you what that would look like from the early period. Before this period here, starting from 2004 on, where we have the higher numbers, as the foreclosure crisis began in the community, this is one Dayton neighborhood in northeast Dayton. You can see probably on the camera just a few of the streets and the makeup of the area. But for every dot you see on this map, that represents a foreclosure. This is just the period from 1997 to 2003. We haven't even imposed upon this map what occurred from 2003 forward. If you imagine, that means that just about everybody living in the neighborhood lives next to a house that went through foreclosure. And what's unfortunate is that a lot of those houses then go on to abandonment. When a house is foreclosed, a family might walk away, and many times families are left in the neighborhood living next to houses like these that become boarded up, sources for criminal activity, lowering the property values, and trapping everyone. If these houses are subject to predatory lending and their neighbors were not, the neighbors still are impacted by predatory lending by having these types of occurrences in their neighborhood and next to them. Well, today, Mr. Speaker, the impact of all of this is clear. It does impact our financial institutions, and it does impact the very fabric of our financial institutions for our community and our country. These are the toxic assets that everyone speaks about. When they talk about toxic assets and mortgage-backed securities, they talk about the real-life foreclosures that have occurred, and predatory lending practices have contributed a disproportionate amount to those impacts. I believe that homeownership is a privilege that everyone should enjoy, but we must not allow for the dream of homeownership to be shattered because of questionable and less than honest mortgage lending practices that can steal individuals' futures. That is why I am pleased to commend my colleague, Brad Miller, on his leadership on this issue and work on securing the passage of H.R. 728 in this body. Brad, we appreciate it. The families who have been impacted appreciate it. This is an important step to changing the rules so that we don't continue the practice of creating toxic assets.
Thank you. Mr. Turner, if you will stay a moment, I have a question or two. I know that your start in politics was in local politics, that you were the mayor of Dayton, and my observation of people who work in local politics is they can't just spout talking points. They really have got to solve problems. They don't have much choice in the matter, and I'm pleased that after more than 6 years in Congress, that hasn't worn off completely. You do still have some sense of the practical to you, which I appreciate. I said a moment ago that I would come back to what went wrong. Obviously, for more than 40% of all corporate profits, they are now on taxpayer life support. And what went wrong was that their economic models, their business models, assumed that property values would continue to appreciate. Home values would continue to appreciate. In 2004, home values across the country appreciated by 11%. And they assumed, looking back, obviously foolishly, they assumed that property values would continue to go up. And what happened when property values simply stalled, they had a business model that only worked if property values continued to go up. They might go up quickly or slowly, but they would continue to go up, and they couldn't possibly go down. But when they stalled, people could not get out of their, more and more people were underwater in their mortgage. They owed more money on their house than their house was worth. They could not get out of their mortgage. They couldn't sell their house because they couldn't pay the mortgage. And property values and foreclosure were just inextricably linked. nationwide property values have now gone down, according to some economists, by about 30% from their peak in 2006. I think it was. And for most middle-class families, the equity they have in their home is the bulk of their net worth. It is their life savings. And they're seeing that disappear. Even the people who have mortgages they can pay, who aren't in subprime mortgages, when their property values collapse, their home value collapse, they see their life savings evaporate with the collapse in home values. As you pointed out, foreclosed homes sit vacant, stigmatizing neighborhoods, killing the property values in those neighborhoods. And in many markets around the country that have been hardest hit by subprime lending and by the foreclosure crisis, half the homes on the market are foreclosures or more, and those houses are priced to sell. In Dayton, what has been the effect of this on home values? What has been the effect of the foreclosure crisis on home values in Dayton?
Well, it's definitely gone down, and Brad, you make some excellent points. Now, our community in Dayton, Ohio, and the surrounding counties, Warren, Clinton, and Highland, that are in my district, we're not an area of the country that saw these large spikes in property values. We had very modest property appreciation. What happened most of the time, I believe, and the Montgomery County Fair Housing Center has statistics where this has been proven out, is that through predatory lending practices and what I believe are also fraudulent lending practices, the loan-to-value ratio got out of kilter. They would lend people more money than their house was worth. Structurally, you cannot maintain that. You're going to have a foreclosure if someone leverages their entire equity. Now, I'll give you an example. Someone might have a house that's worth $75,000. A lender comes to them and says, well, your house is really worth $100,000. I'll give you $10,000 cash out of your equity, and then they'll charge them $15,000 in fees that are rolled up and are capitalized into the loan. So the family now has a $100,000 loan on a house that was worth $75,000, where they got $10,000 to send their kid to college or pay medical bills. But they're now sideways because the house really isn't worth $100,000. So if you have then an economic event where they have difficulty in making that mortgage payment, it's different than economic downturns we've had before. Where we've had economic downturns before, people still had equity in their home. They might be able to sell their home, or they might be able to try to make the payments on the lower value. But once you have a loan on a house that's greater than its value, and people do not have the money to cut the check for the difference, right, they're going to walk away. And they're structurally going to have to leave that home behind. The bank is going to foreclose and take it. You're going to have this abandonment. And as you just said, Brad, what's really important is the people who live next to that house, who didn't have a predatory loan, who didn't take a loan out greater than their value, now see their property values drop because the house next door to them is now abandoned. We have seen stagnation in property values and growth in the Dayton area. Some declines. People who live next to a home that has been in foreclosure see their property values decline. So it's something that doesn't just impact the family. These numbers that you see here of people who have had their home where they've lost it in foreclosure are multiplied by the number of people who live next to those homes. And in some neighborhoods, because there's so many that's happened, the whole neighborhood sees the decline.
You mentioned in your remarks the number of people, the 2.5 million families who've already lost their homes to foreclosure because of the subprime crisis, and you said that estimates are that many more will. The estimate that I have seen by economists at Credit Suisse was that 8.1 to 10.2 million families, more families, will lose their homes by the end of 2012 in the next 4 years. And if that happens, if we can't do something to stop that, it is hard to imagine that anything else we do to fix the economy is going to work. That is going to be catastrophic for those families. Those families will fall out of the middle class and into poverty and probably will never climb back out. But it is going to be catastrophic for the whole economy. One further question. I've talked about the relationship between home values, the collapse of home values, and foreclosures. But a family that has seen their home collapse in value is not going to be in any hurry to go buy a new car or to buy anything they don't have to have. What has been the effect of the economy in Dayton generally? What has been the effect on the car dealerships and the retailers or are you seeing an effect on the economy, the retail economy in Dayton as a whole?
Absolutely. Well, we've had, in Ohio, we've had significant job loss, and that goes to part of the economic crisis that people are seeing. But when you have people's home values drop, just as you said, they have less wealth, and when they have less wealth, they're less secure, so they're less secure in proceeding with other purchases. But an issue that it also impacts them is that when your value of your house goes down because someone else has gone into foreclosure, the value isn't there, and you're also stuck, unable to sell your home. I mean, there are people now who, because the number of foreclosures that have occurred in the neighborhood, who are holding on to their house, who are not able to sell their house and move on to another neighborhood, and that has a suppressing impact on the economy also, because if the value would still been there, they might sell their home and move on. But Brad, I want to commend you again for your bill, because what you're trying to address is the issue that, throughout the country, people know we have a foreclosure crisis. They know that foreclosure crisis goes straight to the issue of toxic assets, which goes straight to the instability of our financial institutions. And this bill, unlike the bailouts that were passed, goes straight to the issue of trying to stop these practices so that we don't continue to crank out toxic assets. That will provide stability in the market, where people will have some confidence back that these loans that are being given have some standards behind them, and that families aren't putting at risk.
I did vote in October for the bailout, the TARP, the Troubled Assets Recovery Program, and it was certainly a bitter pill for me, having been one of the sternest critics of the industry for the whole time that I have been in Congress. I did it because I thought there were exigent circumstances the nation was facing, but I said at the time, we have to reform the industry. We cannot just get back to where we were. We have to address the kinds of practices that led us to where we are.
And exactly to what you said, one other thing that I want to talk about is the issue of how people feel about this. Right. I mean, there are people who live next to abandoned homes that went into foreclosure, who have made their payments, who've seen their property values, and they know that lenders took advantage of the families that were in their neighborhoods, and those lenders are part of where the tax dollars are going for these bailouts. And they want to know, when are these lenders, when are they going to be held accountable, where they're going to be stopped from these type of activities? And that's what your bill does. It goes straight to saying, we're not going to let the lenders to continue these practices. The elements of your bill will have a huge impact on neighborhoods and on families. So thank you for advancing it.
I do want to recognize, well, maybe I won't, because he's not here at this moment, so I'll continue. There's been a lot of hand-wringing by the political establishment, by the political pundits at the populism. They use the word populism as if it's completely synonymous with the word demagoguery, which it's not. With the populist rage at what has happened in the financial sector and the AIG bonuses. To me, I think many Americans know the kinds of practices that have gone on. It's not just mortgages. It certainly is mortgages. It includes mortgages. But it's credit card practices. And we had just last week, or 2 weeks ago, we had legislation that we have now passed that would fundamentally reform credit card practices that many Americans have had very distasteful and very expensive experiences with. It left them furious at that industry, the same industry. Overdraft fees. Overdraft fees doesn't really affect the kind of middle to upper middle class. It is people who really are struggling. And when they get to the end of the month and there's more month than there is paycheck, they might go beyond the amount of money they had in the bank. And the lending industry has actually designed what they call fee harvesting software that batches the transactions, the checks, the ATM visits, the debit card purchases, that batches them in a way that maximizes the overdraft fees. And an overdraft fee is typically $35. If someone gets to the end of the month, they've got $100 in their bank account, and they go to the ATM and get 20. They buy something on their debit card and get 20. They go back to the ATM and get another 20, and make a $15 purchase with their debit card, then another $25, and then write a $105 check. The software runs the $105 purchase through first, charges a $35 overdraft fee on that, and then $35 fee on the 20, the 20, the 20, the 15, and the 20. Americans are furious. And then they see the very industry that they think cheated them on their mortgage, cheated them on their credit card, cheated them with overdraft fees. They see their tax money going to help them, to help save that industry from their own bad judgment. I think it is righteous anger. And I think we need to, as you have said, we need to reform the practices that led us to where we are. Mr. Ellison has returned. Usually...
Mr. Miller, before you go to him, just let me tell you, I do want to, again, commend you for this bill. It's very important. You're taking action that goes right to the heart of the crisis. I'm pleased to support it, as this House was, and we certainly look forward to that proceeding, and thank you for highlighting it today.
All right. Thank you, Mr. Turner.